Hey everyone, it's Rich. Welcome back. Today's video, I want to talk about a couple things. I want to give my first business update. So as we launched our effort to go from 0 to a million, I want to give you an update on where that's going. And then I do want to talk about one accounting topic. So I did want to get a mix of those types of things in these videos. When I did the first video, we were at 0 clients and $0. Since then, I've been able to sign 2 monthly recurring clients. One of them took the basic price of $250, a very simple client, won't take much time at all per month. Another took the simple program, the basic starter program, and then added one additional service they needed for their industry. So that was a $350 a month client. I did get one large cleanup project that was $4,500. So that was a nice cash infusion early on. And I do have 2 franchises who will be starting in January once their business is open. So that'll be on its way soon as well. So it was a great start. All of those clients came through, one was through a referral of somebody I met just in a conversation about starting business. Somebody had a referral. That was the franchise, and the others were through paid ads. And I'm going to go over what I use, but a lot of it's paid ads, social media marketing, networking. So paid ads have actually paid off, which is nice. So I want to give you a quick update on that. We're a long way from $1 million, but you've got to start with those first couple of clients, and we've gotten those. I also have one proposal out for a fractional CFO client, which I think will close. That should happen in the next couple of weeks. And we're still working out the particulars, but that's going to be somewhere between $1,000 to $1,250 a month client. So that'll be a good one too. Okay. So one of the things you do with a client, any new client, is you start to work with them on building out their accounting structure. And the basis of everything we do is our chart of accounts. So chart of accounts is like the name says, it's simply a listing of all of your accounts. And most new bookkeepers, most basic bookkeeping courses are going to teach this simplified method where there's 5 accounts. You've got your assets, your liabilities, your equity, your income, and your expenses. I've always used a 9 account approach. From my days in corporate America, this is what we used. And I'll make this larger so everybody could see it. My first 4 are the same: my assets, my liabilities, my equity, and my revenue. Then for the 5 series, I use cost of sales. For my 6 series, selling expenses. My 7 series, general and administrative expenses. This is going to allow me to give you better visibility into your operating income. And then I use 8s for other income. So these are non-operating items, and the same for other expenses in the 9 series, other expenses. So this is going to allow you to create better reporting, get better insight into the operations of the business versus the overall profitability of the business. So I would encourage everybody to use structure on the right. It's going to show deeper knowledge of accounting. It's going to give you better visibility into all these different accounts and sub-accounts. So once you use that, and the number of digits you use is optional. I just come from a background where we use 7 digits, so I'm used to it. But you certainly could use more or less. The more you use, the more flexibility you'll have. Going one step further, once you have this basic numbering mechanism in place, I lay out my hierarchy of chart of accounts. Now, each of these will be industry specific, but this is the basic template I would always start with. You have your assets, and those assets are going to be typically in order of liquidity. So you're going to have your cash, your short-term investments, cash equivalents, your accounts receivable, your inventory. Again, that's an optional account if you have an inventory business. If not, you could repurpose that account number. Your prepaid expenses, other current assets, your fixed assets, your intangibles, your long-term investments, other long-term assets. I always use the second digit as a 9 for my other category. So that's my catch-all. So you're going to see other long-term assets under liabilities. You'll see other long-term liabilities. So that's one of those things that is my junk drawer of accounting. If it doesn't fit nicely into the numbering system here, I put it into this bottom category. So you would do the same thing with all of your groupings. Under liabilities, you've got your payables, your accrued expenses, your tax payables, unearned revenue, just all your normal liabilities. Same thing with equity. Equity section is going to be highly dependent on the type of entity structure. If it's an LLC versus a C corp, you're going to have very different terminology. The C corp, you're going to have common stock, paid in capital, dividends. With an LLC, you might call it owner's equity, owner's investment. So there'll be some flexibility there. You want to make sure you have space for more advanced accounts like other comprehensive income. You have your revenue. Revenue, you want to be careful with because you don't want to have GL accounts for every revenue product. You want revenue types. So it could be service revenue, product revenue. For my accounting business, I might have assurance revenue, tax revenue, bookkeeping revenue, consulting revenue. So it could be different groupings. Then within those, you use the products and service features. So I could have one grouping of taxes and then the different types of tax returns because you do want visibility and reporting on all of those things. Other things to consider with revenue is that what one industry's revenue is could be another industry's other income. Rent is a great example. So working with a lot of real estate investors, rent is going to be a revenue item. They're going to earn a bulk of their money through rent. There are businesses who are not in the rental business. A big box retailer. We've all been to them. You might see a kiosk at tax season for a tax franchise. You may see a nail salon or a fast food restaurant inside. So if they're engaging in some sort of piggybacking where they're locating inside of another location, that rent is often other income. It's not a core piece of their business. So depending on what your business is, that's where it would go. If you were a financial institution, interest income obviously would be a main revenue item up above. But for most businesses who earn some incremental interest on some savings deposits, it's going to be other income. So I set up this hierarchy first, then I start to build it out depending on the client needs or the industry. So under that cash section we saw, you then could list your different types of accounts. You could have an operating account. This could be further broken down into operating account at Bank A, Bank C, so forth. So you've got operating accounts. If you have a heavy AR business, you may have a clearing account, payroll account, savings account. Some businesses run everything out of an operating account. Some break it down. So the structure is there for you. Again, heavy AR, you're going to want your clearing account where you could apply the AR later on, but you can at least get the deposits in. Then it's broke out another section, prepaid expenses, for example. You've got your main account, and then you've got all your sub accounts with the different types of prepaid. So these things are not always necessary, but they are always very helpful. And some industries, this is going to be important to do this. I'm going to give you one example with specifically to real estate. This is just a snapshot of a normal chart of accounts you might have for your real estate developers. So it's always going to go into your property, plant, equipment, GL. Then you're going to have something, you might have undeveloped land. You could have rental properties. You could have construction in progress. You could have a lot of different things, but we're just going to take a look at these three. So you could have a real estate developer who owns land with no intentions of building on it or developing it. It's just held for future use, maybe short-term, maybe long-term. So you have the acquisition costs of the land. Some improvements are deductible, or some improvements are capitalized and depreciated. Others are not depreciated. Land's a little unique with that, where land itself is never depreciated, but some of the improvements may or may not be. So you have your land and then your land improvements. Then you have, and the reason they're up here is these are the non-depreciable ones. And then you have your land improvements, which are depreciated, and you have your costs and your accumulated depreciation. So you want to group things that are not depreciated together and things that are depreciated together. Under the rental properties themselves, you want everything to roll up to one number of rental properties, and you have your net book value. To get that, you would break out the land portion, what it cost you to purchase the land, what about improvements you made that are not depreciable. Then you may have your land improvements. What did those cost? The depreciable part of that. Your actual building, the improvements on the building, your capitalized financing costs and other soft costs, which are capitalized. It could be engineering, things like that. So you want to make sure you have all these different groups broken out for visibility and reporting, but that ultimately they'll roll up into one master account. And you would just fit this out for whatever else you have. So if they're a developer who builds properties, you'd want work in progress accounts. If they're a flipper, that's a whole different set of accounting rules. We'll talk about that in a future one where you're going to start to have inventory. You may need to take them out of this section of the balance sheet and put them into long-term investments. So something like land, if it's not going to be used in the short term, it may have to come out of here and be held as a long-term investment. It just depends on the circumstances and the rules. But as a general rule, this is the typical treatment. And how do we know that? Well, we go to our GAAP and our ASCs. You have your 970 and your 360. So your 970 is real estate, 360 is property, plant, and equipment. You know, you're going to add to that down below your 835 for your interest costs. So there's the rules on capitalized interest. So you lay out this framework that's going to give your clients the best visibility and your ability to create the most reporting. So if you're a real estate investor who feels they would benefit from this level of detail, definitely book a call below using the link. We can have a discussion on how we can implement this system and how Entrie can either manage your accounts for you, or we could talk about our Entrie in a Box program where we'll put the system in place and your team can run with it. If you're a bookkeeper who's interested in this more technical field of bookkeeping and would like to discuss how to develop your career further, again, please book a call. So that was the quick recap on chart of accounts, a little bit of a business update. And with that, if everybody could please like, share, and subscribe so we can help reach more people and bring this interesting area of accounting and bookkeeping to more people, that would be fantastic. Until next time, this is Rich. Goodbye.